Hello Ebenezer, this is Dennis Tyler at Capital Financial Mortgage. Ebenezer, as you and I discussed, I have put together an analysis for you that I think will be most helpful in determining what kind of a loan program may be best for your particular situation. You indicated to me that you wanted the very best deal possible, and so that's what I'm going to go through with you, is how to achieve that goal and make sure you're getting the very best deal possible. I'm going to ask you a question first, however. What if you could save hundreds of dollars every month? Ebenezer, what would you do with that money if you were to save a bunch of money every month? Would you buy a new car or pay off your existing car? Would you put your son through school with that money? Or perhaps you and your wife would go on a very nice vacation. As a certified mortgage coach, I'm qualified to help you make that a reality. Our objectives, if I understood correctly as we discussed, were first off, you would invest 30% as a down payment. You wanted a 30-year fixed mortgage, and you planned on living in the home for, between 5 and 7 years. And also, as you indicated, and as I already reiterated, you wanted the very best deal possible. I would encourage you to have a pen and paper handy, because we're going to be discussing some of the things here that might cause some questions in your mind. You may want to ask me questions later on. First off, I have put together a personalized mortgage plan. This is just for you and your situation. The very first thing I wanted to show you is that as you look right here, with a 30% down payment, your loan amount would be $420,000, and that's based upon that purchase price of $600,000 as you had indicated. Well, the problem with the $420,000 price range, Ebenezer, is that it's just above our conforming loan limits. And so what I'm going to suggest is that we take a look at a loan amount of $417,000. At $417,000, your interest rate is 5.25% instead of the 5.375% that $3,000 difference makes. Now, if you take a look at that, the savings using a 5.125% interest rate is $81 a month. What that means is that you're going to be saving about $6,000 over the next 5-year period of time, and investing just the $3,000 extra in the down payment. So you have a lower principal balance, you save $6,000. Bottom line is that you're going to end up with about a 200% return on your investment. Ebenezer, I've also taken a look at a 10-year adjustable rate mortgage as well as a 7-year adjustable rate mortgage, again based on the fact that you had indicated that you would only be living in the home not more than 5 to 7 years. And I'll share with you some of the pros and cons both ways. You might just take a look here, though. Using a 7-year adjustable rate mortgage, your monthly savings is $331 a month, and on a 10-year adjustable rate mortgage, the interest rate is 4.625%, and you save $208 per month. Now, what that means, though, is that over a 5-year period of time, you're going to save $16,000 versus on a 30-year fixed, the $6,000, so a $10,000 difference there. And then if you were to consider a 7-year adjustable rate mortgage, over just a 5-year period, you actually save nearly $27,000. That's actual cash savings over a 60-month period of time. Now, I also wanted to show you that if you took the monthly savings from each one of these programs, so if you saved the $81 by going with the little bit lower loan balance, the $417,000 instead of the $420,000 loan amount, you save the $81. If you invested that over a 7-year period, let's just say at a 5% return, then you're going to have an extra $8,000 saved up over that 7-year period. Or if you took the $208 a month savings on the 10-year adjustable rate mortgage, you're going to save just about $21,000 over that period of time, or $33,000 looking at the 7-year adjustable rate mortgage. And if you took that money, the savings, you would actually be able to pay off your mortgage in less than 22 years. I want to show you one more strategy, however, that could save you even more money. This is called the seller buy-down strategy. In this case here, we're going to assume that the interest rate would be 5.125%. That's what a normal loan officer would quote you, and that's a standard strategy right there. You'll notice, however, that if we go in and negotiate with the seller to pay 3 points, buying your interest rate down from 5.25 to 4.625, then your monthly savings is $127 per month. If we took a look at the 10-year adjustable rate mortgage, and the going rate right now being the 4.625, but with that same 3 points, we're able to buy the interest rate down to 3.625%, saving you $369 a month. What that means is that you save over a 5-year period $10,000. Over that same 5-year period, $31,000 using a 10-year adjustable rate mortgage with the seller buying it down by 3 points, or approximately $12,000. Now, again, if we took the savings, the monthly savings on a 30-year fixed mortgage with an interest rate bought down to 4.625%, you would be able to pay that home off in about 26, 27 years. On the other hand, if we took the $369 a month savings with the 10-year arm, investing that at a 5% return, you would actually have your home paid off within 21 years. Pretty cool assessment there. Ebenezer, my recommendations for you then is that we indeed do use the loan amount of $417,000. We go for a 10-year adjustable rate mortgage subject to the length of time that you're going to be owning the home. And I would suggest that if you're not sure that you're going to be out of the home within 10 years, then we go with the 30-year fixed. On the other hand, if you're certain you're going to be out of the home within 7 years, we would change this to the 7-year analysis and do that. I'm going to suggest that we ask the seller to buy down your interest rate, saving you over $31,000 in just over a 5-year period of time. And we keep your payments $369 a month lower than what they would be otherwise. As a certified mortgage coach, the next step that I suggest is that we get together, we complete your questionnaire. We're going to discuss more and choose the best loan option. I'm going to go ahead and give you a pre-approval certificate for your new financing. We'll lock in your interest rate at the right time, and that's another discussion for us, and we close on time. Ebenezer, give me a call tomorrow, or I will give you a call. We'll discuss those options, and once again, I look forward